Good morning and welcome to the Shenkman Wealth Management Accountant Attorney Spring Webinar Series. This program is entitled Using Tax Insurance to Achieve Tax Certainty in Estate Planning and Wealth Management. For those who don't know me, my name is Jonathan Shenkman, and I'm the president of Shenkman Wealth Management. In that role, I work as a financial advisor, portfolio manager, and serve in a fiduciary capacity to help my clients achieve their financial objectives. The goal of my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 25 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You could read my work in Barron's, Bloomberg, CNBC, Fortune, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. You can see all my work on my website at shenkmanwealth.com/articles or by following me on social media at Shenkman on Money. Additionally, I just launched my podcast, which is also called Shenkman on Money, and you can check that out at Apple Podcasts, Spotify, or wherever you get your podcasts. Today, we're privileged to hear from Daniel Berger and Michael Saitta, both based in New York. Daniel is the Senior Vice President and Head of Tax Insurance at Lockton. Before joining Lockton, Dan led tax insurance underwriting for AIG in North America. He previously worked as a tax director at Brookfield Asset Management and as an associate at Moelis & Company, both in New York. Daniel began his tax career as an attorney at Proskauer Rhodes, where he advised on various transactional tax matters. Mike is head of tax insurance for the Berkshire Hathaway Transactional Liability team and is based in New York. He provides bespoke coverage for a broad range of tax matters in the U.S. and around the globe. Prior to focusing on tax liability products, Mike spent time underwriting the related representation and warranties insurance products. Before that, he worked at PwC, where he oversaw tax due diligence, provided tax structuring advice for private equity and corporate clients on a variety of M&A and internal transactions. Today, Dan and Mike will be speaking on using tax insurance to achieve tax certainty in estate planning and wealth management. And with that introduction, I will now turn the program over to Dan and Mike.
Thank you, and it's great to be here this morning. I go way back with Jonathan Shenkman, and I knew him actually before he was famous, and certainly great to see him really all over media, both social media and print. Pretty incredible. What you've been building, and really a pleasure and honor to be here this morning. What the topic we're going to discuss, is certainly is maybe new for many people here, but at the same time, it's actually been a product that's been around for over 20 years. It's grown exponentially over the past 5, and there's a variety of reasons for that, some of which we'll get into. But tax insurance, is pretty incredible in terms of the different applications that it has, specifically in the wealth planning and trust and estate arena. What we'll do is we'll give an overview of the product. We'll talk about some market trends. We'll talk about the process of obtaining insurance, and also talk, specifically about particular circumstances where it's been used and where it could be applicable. So, with that, we'll get started. I know we don't take questions, but to the extent that anyone does have questions, feel free to reach out to either Mike or myself afterwards. So tax insurance is really meant to provide coverage for any type of uncertain tax position. So to the extent that a company, an individual gets advice from a tax advisor, whether it be an accounting firm or a law firm, ultimately a tax authority such as the IRS could disagree with that tax position, and the individual, a company, would still have to pay the tax and potentially interest and penalties as well. What tax insurance provides is a financial guarantee that in the event of a challenge, that the client could be made whole. And the coverage is intended to be comprehensive in nature. Mike will talk about the scope of loss, but that's really the essence of the product, is providing that certainty. Tax is a very complex area. A lot of gray areas, a lot of questions, a lot of uncertainty, and in a very challenging environment, where, especially with regards to sort of complex tax structures, there's certainly no sort of black and white answers when it comes to tax. You know, when you ask a tax advisor a tax question, oftentimes people actually make fun of it, tax advisors, and I was a tax lawyer myself when I started my career, that tax people always hedge, right, and give sort of qualified answers that are not straightforward. And there's certainly truth to that, and that's sort of the reality. It's not really a tax person trying to be vague. It's really just sort of reflecting the reality of the tax law and the fact that there are ambiguities and uncertainties there. So especially in the context of situations where there is uncertainty, unfortunately, it's not something advisors can sort of guarantee. That's not really the way their advice works. What tax insurance provides is that certainty. It provides, that financial guarantee that in the event of a challenge from a tax authority, that there would be protection. So that's sort of a very high level intro. And maybe with that, I'll turn it over to Mike, and he can talk more specifically about sort of what the product covers.
Yeah. Thank you, Dan, and thank you, Jonathan, as well for having us on. Certainly a topic that is near and dear to Dan and I's hearts and keeps us busy every day. So we definitely like to take a chance to talk about it and tell more people. So in terms of the scope of loss, it's really meant to be a comprehensive solution. So it's intended to address all relevant costs in the event of a claim, right? So certainly any taxes which are ultimately due, that could be federal as well as state or local, as well as any assessed penalties and interest. Where the policy, I think, really shines and offers even more of a benefit in terms of what it can address is certain ancillary costs, such as defense or contest costs. So again, that's the expense, right, of dealing with the audit or challenge to the position. That's picked up by the policy. It also is worth noting that along with that, the insurer will often have their own counsel or advisors assisting in the instance of a claim. And that really adds to kind of the overall defense team and the ability to, protect and stand by the position that's been taken. I should know that the taxpayer would still control the contest and make decisions, with the ability to have the insurer involved and aware of what's going on. But again, that costs both on the insured's advisors and the insurer's advisors are all picked up, by the policy. There's also a gross up element. So to the extent that a loss is ultimately paid and is treated as taxable income, in the hands of the insured when that payment is made, the policy, assuming it's sized correctly in terms of the, amount of limits which are purchased, can also pay a gross up, right? So really the goal is to get the taxpayer back to where they would have been, had this not occurred. And that goes to that comprehensive solution. The policy also can often address any advanced tax payments. So, in certain jurisdictions that may be necessary. In the US, more common in order to, contest or appeal, right? The term pay to play often comes up, but the policy is capable of doing that and will often make that decision in order to, mitigate potential interest or other costs that might be associated with a claim.
That's exactly right, Mike. And, it's interesting sort of mentioning that you can see sort of federal, state, non-US taxes covered, even within sort of the federal tax world. Do you see coverage, not just, let's say, for income taxes, but for other taxes as well?
Sure. We've seen policies address any manner of taxes. So, specialty or excise taxes, non-income or indirect taxes. In this space, certainly we've seen an estate and gift tax, coverage be available, inheritance taxes, and income taxes. It's worth noting, or other, excise taxes as well, aren't just targeted for, say, individual taxpayers or just a business or an entity, which has a filing return or filing obligation or takes a certain position, the policy can, be available for any of those vehicles. So individuals, trusts, corporations, or other entities as well are all, viable insurers, and depending on the scenario, can take advantage of looking at a policy.
Yeah, no, that's great. So maybe I'll talk a little bit about some market trends and some features of a tax insurance policy. So generally speaking, a tax insurance policy is for a 7 to 10 year term. So it's out there for 7 to 10 years, which is really intended to cover the full statute of limitations. Tax insurance is quite unique, relative to other lines of insurance, which typically renew on an annual basis. That's not the way our policies work. The tax insurance is really paid for completely upfront. There's a one-time cost that's payable at the outset of the policy, and then again, it's out there for typically 7 to 10 years. The general range in terms of pricing for a tax insurance policy is somewhere between 2 to 5% of the potential exposure. That's, the general range, could be wider than that. These policies are very bespoke and quite tailored to the nature of the underlying risk being insured. And that sort of gets to, the types of positions that can be covered by a tax insurance policy. So, tax insurance is really covering positions where there's a sort of a strong basis for the position, as opposed to simply playing the audit lottery. We generally are looking for something where there's at least a more likely than not level of comfort. That being said, there's I would say probably the vast majority of the policies that we work on, there's actually not any type of tax opinion. Oftentimes there is though some type of memo, written analysis from a law firm or an accounting firm that helps support the position and sort of provides the analysis and support for it. I do want to emphasize that, excuse me, that tax insurance is not available for any type of abusive transactions. So, think listed transactions, most reportable transactions, lost transactions is an exception. But for any type of really abusive tax shelters, tax insurance is not available. It's really there to ensure, reasonable positions where there is support for it. Again, as I mentioned, at least a more likely than not level of comfort. In terms of market trends, as I mentioned, sort of tax insurance has been around for over 20 years. Over the past 5, it's really grown exponentially. And there's a variety of reasons for that. Part of that is there's a lot more insurers in the space now. When the product was really around for its first couple decades of existence, there really, let's say, only about a handful of insurers who were willing to provide this type of coverage. And that made the coverage pretty expensive, just because there was really a lack of competition. The appetite was also quite narrow. So there was really only appetite to cover, situations where there was a should level opinion, an actual opinion was required. And that's changed and have certainly evolved over the past 5 years. Now there's 23 plus carriers in the space, and each of them have their own dedicated tax underwriter who with meaningful tax experience, who can help that insurer determine whether or not they're comfortable providing the insurance, and if so, what the terms and conditions should be. And so that's certainly something that's had a pretty meaningful impact on the product. And again, as the sort of the cost of the insurance has come down probably between 30 and 50% for certain risks over the past 5 years, as it's become more economical. Again, that's also facilitated a lot more policies getting placed. So, there's sort of a variety of factors that have contributed to that, including the rise of rep and warranty in the M&A space, that has made the product a lot more popular. So those are some of the market trends. And maybe Mike, do you want to talk a little bit about sort of the process of obtaining insurance and who the players are?
Yeah, of course. And I think one of the points that you made, Dan, in terms of kind of the advice being available is a good place to start, right? So, whatever format that advice takes, it's interesting because I think, anytime you have a good position, certainly, as we said in the beginning, it's never without doubt. You don't have a guarantee, but when you're comfortable that you've got a position that you want to take and there's advice being solicited, a strategy is being put together, when that planning process is going on, especially whenever there's a high dollar value or something is particularly complex or requires sort of a lot of moving pieces, those are opportunities that I think, are potentially great candidates for the tax insurance product, right? And that advice that's being put together in whatever form is ultimately crucial to the process, right? So step one is, when you're working on that planning, when you've got, ideally it's when you're working on the planning. I should say it's not impossible to get the process started afterwards, but we would encourage people to come out sooner, whenever possible, to gather the information and see how, the insurance product may fit. So that first step is going to be speaking to a broker. Certainly Dan is a great option. We would recommend, taking the information to him. He's going to take a chance to vet that position, understand the facts, understand, the insured's needs and goals and what they're hoping to achieve. He'll then put that information together into a formal submission package. That submission is sent out to, numerous markets. I think Dan mentioned the numbers up to 23, which always kind of blows my mind, but certainly good to know, and see that growth, right? Those underwriters that are available at the various carriers and potential insurance representatives are going to review that submission package. They may have some questions from Dan, a little bit of back and forth, right? Ultimately, that will result in preparing quotes, and that'll give Dan a sense of where the pricing is and what different coverage is being offered. Certain insurers may take slightly different views, and some of those approaches or quotes may be better suited to, a given taxpayer's needs. So working with Dan, the taxpayer would then select an insurer from those various quotes, and underwriting would begin. So the underwriting process in some ways is a bit like a due diligence process. The underwriter will often have a number of additional document requests, perhaps some written follow-up questions. They'll often schedule an underwriting call to get a chance to go through the facts and the materials. Most underwriters, especially on a more highly technical or complex, matter, will engage their own outside counsel just to assist in the underwriting and diligence process. So once that call is held, typically we'd begin working on the policy form. So while it starts as a bit of a template, and Dan and I or any number of carriers and brokers are going to have sort of template forms to start, it really is a very bespoke policy. It's a thoughtful policy contract that's going to be carefully negotiated and drafted to address the specific risk, the specific needs of the insured. And that process is going to involve, obviously, the taxpayer, but also their advisors to assist. Dan or whoever is the broker on the policy is available to sort of add input and advice. Someone like myself on the underwriting side is going to be, making sure that the insurer's needs are met in the policy. And once those, two sort of corresponding processes wrap up, the underwriting and diligence, along with the policy, form drafting, we're able to bind, a policy. And at that point, the insurance is available. The policy is on risk. The insured, the taxpayer is covered. And, I think, Dan, at this point, it might be worth mentioning, I'll kind of kick it off and then, feel free to add that, the policy will spell out really clearly, what a potential claim scenario is, how that would work, So you really know in advance kind of how that would develop. But the basic way to think about a claim on this policy is, any involvement from a tax authority. So once you've got kind of a notice, formal audit, when you've got that interaction that the covered position is ultimately coming under some kind of scrutiny, from a tax authority, that's when, a claim can be made and the policy is available. And again, I think it's worth noting that that's really spelled out nicely, and pretty easy to follow in the policy contract.
Yeah, that's right, Mike. Another thing I'll add in terms of the process, I think, you detailed it well in terms of what it entails. From start to finish, we've done this as quickly as a week. We prefer to avoid those types of situations, but generally speaking, it's something that could take 2 to 3 weeks from start to finish. But our markets are accustomed to working on deal timelines, so that there is some flexibility there, but ultimately it really just depends on the flow of information and how readily available it is. In terms of sort of thinking about the types of issues that are covered by tax insurance, the interesting thing is that, again, as I mentioned, for many years, tax insurance would really cover sort of very technical tax positions. One change that's occurred more recently, which I think has made the product better suited to being useful in the estate planning arena, is the fact that not only can the product cover sort of technical tax issues, but it could also cover valuation related risks as well. And there, when you think sort of about valuation related risks, right, the loss could be measured in tax dollars, but the trigger for that loss may not be sort of a technical advice from a law firm or an accounting firm. It could be sort of whether a valuation from, so let's say some type of third-party valuation firm would be respected by the IRS. And that's obviously something that's pretty critical for wealth planning in the trust and estate space. Because of the flexibility of the product to be able to cover valuation related risks as well, I think that's something that I think has driven the growth of the use of the product specifically here. Just to sort of break down where we see tax insurance used, I think there's really sort of 3 broad buckets of risks that we see covered. One relates to sort of the M&A space with regards to mergers and acquisitions, when anything that's sort of identified during the diligence process that a buyer performs when it's looking at a seller, when it's looking, at acquiring a target from a seller. There you could see coverage for either any issues identified during diligence or the tax consequences associated with the transaction itself. The second bucket of risks, I would say, relates to tax credits. So certainly anything, relating to renewable energy tax credits and other types of tax attributes that may be available. And then I think the third bucket, really relates to sort of just protecting one's own balance sheet, right? And that could be in the context of a company, either looking to protect its own balance sheet or individuals, right? And certainly we see that in the trust and estate, area, where again, just, individuals, families that utilize complex wealth planning techniques, which are intended to potentially save meaningful amounts of money in terms of taxes, that there are some risks associated with some of those strategies. And obviously there are certain ways to mitigate that risk, and getting good advice from a tax advisor is a minimum, at a minimum is required, and certainly needed in order to be able to even consider insurance. But certainly beyond getting advice, in order to really achieve that certainty, tax insurance is one way to do that. And Mike, I don't know if maybe you want to mention a couple of specific areas where you've seen it used in this area.
Yeah, absolutely, Dan. The first thing I think I'd like to say, just to show the breadth and the flexibility of the product, is that a single policy can, in theory, address more than one covered tax position or position which has been taken. Typically, that's, assuming it all revolves around, say, the same, transaction, same planning. There can also be multiple policies around a single set of facts. If you've got other insureds, different folks, different people in the process who might need coverage for slightly different issues. So again, just want to, reiterate that flexibility. In the trust and estate space, we often see a lot of business transition planning, right? So, certain freeze transactions, certain, large liquidation events for closely held businesses are often paired, right, with, other trust or long-term wealth planning, for maybe the beneficiaries, for other family members. So certainly there's a lot of ways to achieve those different goals, and the facts are going to be a bit different each time, but that's very common. I know Dan mentioned, M&A transactions, which is not necessarily the focus here, but often a lot of those closely held businesses are going to be in the form of an S corporation, which raise a lot of diligence issues, maybe not often a high risk in the eyes of the seller, but buyers are often unwilling to take on that risk. So, that's a very common use of, the policy. Certainly, as Dan mentioned, valuation often factors into it. And so coverage for aspects of valuation that support a position, can be addressed as well. And then, sometimes there's changes in beneficiaries, there are changes in circumstances, there are, just changes in family planning that necessitate making adjustments to sometimes long-standing, existing trusts. One example too there, I think, is we see when certain trusts or different vehicles are wound up, there's often a question of, is there any lingering liability, right? There's an important fiduciary duty that's involved in not only administering, but certainly the closing down or wrapping up of any of these types of, structures and planning that's in place. So a policy could be a good way to ensure that, a specific trustee or that the, structure or plan that was in place in general is not challenged later, certainly when there may have been a full distribution of any of the underlying assets. One other topic, Dan, I'm not sure if we hit on it. I apologize if you mentioned it. Typically, we see these policies start around $5 million in limits for size. That's certainly a flexible number. And in many cases, it's not quite as large as it sounds, because as we spoke about, it can address a number of items of loss. So once you've, kind of put all that together and, realize how many different ways in which the policy can sort of, address or redress a loss, and make somebody whole, we see the numbers creep up quite a bit from there as well. Dan, I think your mic may be muted.
Dan, you're muted.
All right, so maybe just to add a couple of quick examples of where we see the insurance used in the space, certainly with regards to defined savings clauses, trust planning sales to grantor trusts, estate of Powell issues, gift taxes, freeze partnerships. I think those are sort of all, examples of where we've seen the insurance be quite useful for clients. I know we're sort of reaching the end here of the webinar, but just wanted to sort of just take the opportunity again to thank you all for joining. Thank you, Mr. Shenkman, for having me on, having Mike on. It was great to be able to join you. And certainly to the extent that you have any questions, feel free to reach out. I know that I believe our contact information will be circulated.
Great. Thank you so much to Daniel and Mike. This was a very informative lecture, and I'll be sure to include both their emails in the follow-up email to this program tomorrow morning, so you can reach out with any questions that you may have. As I mentioned at the onset, the goal of these programs stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. 3 more quick items before I let you go. First, this is my final webinar for my spring series. However, I'll send out an invitation to my fall webinar lineup in the coming weeks. If you have a friend, colleague, or client who would like to be notified of my fall webinar series, they can email me with the word webinar in the subject line, and I'll be sure to add them to my webinar distribution list. Second, you can follow all my work on Twitter, YouTube, and Instagram at Shenkman on Money. And you could also listen to my new podcast called Shenkman on Money, which is available on Apple, Spotify, or wherever you get your podcast. And finally, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees. And I thank you in advance for that. With that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.